Singapore's circuit breaker measures have now been eased, but it's not back to business for everybody. Developers' show galleries will remain closed, and property agents still won't be able to have face-to-face meetings or viewings with prospective buyers. Amid these challenging operating conditions, new private home sales fell 12% in the first quarter. In the same period, prices fell 1%. Most market watchers expect prices to continue this downward trend.
We are projecting that possibly private home prices may dip between 3 to 5%. But of course, the price weakness, we are not expecting it to be uniform across the whole industry, because it really depends very much on the market segment. So for instance, like some of the new projects that have been selling quite well, or in fact some of the mass market projects, they've been selling maybe 50 to even 70% as of now. So some of these projects, prices will be more stable. But if you look at other segments, for instance, like the resale market, there could be more price pressure.
Every crisis brings with it price volatility, but analysts say that historically, property prices in Singapore have always recovered quickly after each economic shock. This was the case during the Asian financial crisis over 2 decades ago, as well as during the 2008 global financial crisis.
Towards the end of 2008, it was really a panic situation. Many investors are all linked to America. And one of the biggest concerns was at that time not knowing where the bottom, who's going to go bankrupt and how many of us are going to be dragged into. And because of that, there was a panic selling in the real estate market in Singapore. And we experienced a 25% drop just over 3 quarters when the global financial crisis happened. When I compare it to the current pandemic, it is totally a different comparison, because the entire world is affected. So nobody is panicking, no developer is slashing prices, and therefore people are holding and people are accepting that this is something only patience will ride over. And because of that, I think the property prices are expected to remain relatively at a reasonably strong position because of the demand from foreign interest and as well as very good government policies in place.
These policies include past cooling measures, such as the Total Debt Servicing Ratio, or TDSR, and the Mortgage Servicing Ratio, or MSR. As a result, Singapore has not seen significant numbers of homeowners defaulting on mortgages. Another big difference from the 2008 crisis is that interest rates are at historically low levels, which means that it is cheaper now to get a housing loan. Analysts say that this has spurred both locals and foreigners to continue to shop for Singapore property. ERA says it even sealed several deals with Chinese buyers during the circuit breaker after giving them virtual tours.
They have already come out of their circuit breaker period. All right, so they're actually looking to invest, and because the yuan is depreciating, so they're actually looking to invest overseas to preserve their wealth. And a lot of these wealthy people, they believe strongly in real estate investment as one of the very important tools to build wealth and to preserve wealth. And they have been looking overseas, and Singapore, naturally being a safe haven and being a very well managed and safe place, attracts this type of buyers, and they buy for the longer term. Don't forget, these foreigners, when they buy, they have to pay 20% ABSD.
Market watchers also say that developers have limited room to cut prices.
If you look at the past crises, the margins for developers were quite healthy, I would say between 20 to 30%. Compared this time around, the margins have fallen and has been thinning over a period. The key reasons being that there has been quite a bit of competition to acquire land because of this recent en bloc cycle. Developers are sitting in expensive land banks, and if you going forward, construction costs are also going to rise. this is going to put pressure on the developer margins, which is already low at around 5 to 15%. So considering these factors, developers also have much less room to cut property prices going forward.
So what is the advice for both buyers and sellers, given the current situation?
All crises do provide opportunities. How we wish many of us would have bought properties during the SARS in year 2003, or for that matter during the global financial crisis, as we just talked about, the property prices like 25% in 3 months, and the following 3 months went up by 30%. People would have gotten a killing. But today it is not dropping hugely, but I must say developers are pricing sensitively with low profit margins and some special discounts for certain particular specs. And at the same time, in the resale market, the buyers are not asking a huge amount of price, knowing the current market sentiment. So there are opportunities for buyers.
For sellers, it also depends on how desperate you need to offload your unit. If you are in need of the money, or you need to sell your unit because you already bought another unit and to shift over, then you have no choice. You probably have to sell, but likely prices may be slightly lower than before the pandemic. But if you can wait, then of course waiting price may recover after the pandemic. But of course, if you are selling high, then if you want to buy another property by then, prices will also increase.
And analysts also see the HDB market remaining relatively stable during this period as well.
In the past years, we have seen that even through crisis periods, HDB prices tend to remain relatively stable. And if it does come down, it is at a measured pace. Similarly, if it does go up over time, it is also at a measured pace. So today's HDB market is dislodged from the investment market. It's not affected by ups and downs of market sentiment, largely because it's bought and sold for owner occupation.